Good morning and welcome to the inaugural edition of Dirt. Yep, it's me, it's Matt Fleming back again, but this time to dish the dirt for all and sundry inside the residential construction industry. And don't worry, that doesn't necessarily mean that I'm going to be revealing secrets about any one of you, provided you send the money to the address that I gave you. We are in between premises at the moment. This is the new market forecasting webcast. It's still going to be squeezed into half an hour, but this time now it's backed by Henry. And while we wait for our new base and our new HQ to be established, it means we're a little bit Heath Robinson. In fact, I wish I could turn the camera around and just show you some of the kit that we've actually got set up. But much more important than all that is what we're going to deliver today. And it's an interesting thing when you actually start to think about putting a deck like this together. Dirt, by the way, just in case you hadn't already noticed, stands for Developer Insights and Residential Trends. For the webcast that I've been doing for the last 3 years or so, we have 1 or 2 retail viewers, but generally it was a webcast specifically for developers, and this is unashamedly so. So it's the DIRT, Developer Insight and Residential Trends. But you'd be amazed, I actually checked back. We have been to 104 different sources of information to put this 30 minutes together. Extraordinary but true. And that goes from like hard bitten down to the knuckle data, right through some algorithms you could possibly question on the odd occasion, and even anecdotal stories back from frontline salespeople up and down the country. And all of it comes together to actually construct this 30-minute webcast. And the whole point for me is it has got to deliver something worthwhile. And that means it's all about innovation. And I've been thinking long and hard. One of the big issues that we have in trying to gauge where the market currently is and where the market's going to go, and of course that information is crucial for forward planning, both in the medium and long term, is that there are a raft of indices. How many do you follow? Right now in the UK, there's probably 5 different indices that you could actually go to give yourself a steer on where the market is. We'll discount the first of them, the most widely used actually, Rightmove, because that's an index of asking prices rather than sold or selling prices. So that brings us down to 4. And I think we can all agree that the gold standard amongst those 4 is the Land Registry. Brilliant, all done on achieved prices, even though they do then go back a few months later and adjust those prices afterwards. But it is the gold standard. The big problem is it's miles out of date. So the very latest Land Registry numbers you'll get right now are as at the end of March. And here we are just about to bump ourselves into June. A scorching May at the moment, but June is just around the corner. So Land Registry, gold standard, but out of date. And that leaves us Halifax. That's the big daddy, isn't it? That was the 1983 index, where it all kicked off, being measured on a monthly basis, giving yourself an index score and watching the trends. And it's been incredibly useful down the years. And a couple of years later along comes Nationwide, and the Nationwide, as they expanded their business and did more and more higher percentage of the UK mortgage business, that index itself became more and more useful. And for me, probably in the last 10-15 years, Nationwide is my preferred index of those 2. So indices based entirely on sold prices, mortgage approvals. And then, of course, we've got Zoopla with their blended algorithm, which takes a bit of asking prices and takes a bit of sold prices, takes mortgage approvals, and you get a blended algorithm, which I've noticed over the last couple of years in particular has got better and better. But which one do you actually reference and which one do you rely on to give you a really dependable, reliable trend which enables you to do your short and mid-term planning? Well, today we are going to give you something completely new. The HDCI, the Henry Dynamic Composite Index, which actually measures the performance of all those indices against the gold standard and dynamically creates a composite of all of them. So we're going to give you something brand new over the next 30 minutes. I need to press on, otherwise we'll never get there, will we? This is roughly what our content's going to be about today. We're going to have a look at the media. That's very important because it sets the scene, not only for people that are actually thinking of buying, but for your frontline team, the people in the sales offices, the sales managers, sales directors. They are taking in all of the news that they're fed in the media, and whether it is conscious or subliminal, it will affect the way that they interact with potential buyers. And that will not only affect the rate of sale, it'll affect the value of every sale too. We'll have a look at the mood then. We'll see what the media's got to say, and we'll see how that reflects on the mood. And in there, obviously, we're going to spend some time talking about consumer confidence, because that has such a mammoth effect on what we're doing. And another new innovation that's going to come up at the end of the 30 minutes webcast that we've got planned today. We'll take a quick trip through the boring bit. We need to look at the metrics. The reason it's important to look at the actual metrics is I don't want you thinking this has been invented and dreamt up out of thin air. It's very, very important that we look at the detail, and then, of course, how that affects the market, where the market currently stands, where it is trending, where those trends are headed. And then I'm going to introduce you finally, before we leave you in half an hour's time, with the magic. So the whole point of this is, rather than just tell you stuff that you can either look up yourself or you might already know, I'm going to try and deliver you some stuff that you can't possibly know because it hasn't happened yet. And that's always tricky then, isn't it? All right, what about the media? Well, let's take a run through just some of the titles that regularly comment on the UK property market and, of course, affects everybody's thinking. The Guardian were in. This was at the beginning of the month, by the way. Housing market in England and Wales weakening due to the Iran war. The Iran war has had such a big effect, hasn't it? And not just on people's confidence and how they feel about things going forward, but also obviously on things like oil prices and inflation, world markets and so on. Hopefully, everything that we hear says that's coming to an end. I know it's no good relying on the latest issue on Truth Social from Donald Trump. I think yesterday he had to say that it was nearly all done and all over just before the Iranians popped in and said, we don't know what he's talking about. In fact, I don't even know I've ever met the guy. So we need to be careful with that. But that's the Iran story has been big news, hasn't it? All over the last month. The Telegraph, the slump word is in there. I haven't yet found a plummet or a plunge, but we have got the slump word out of the wardrobe. And here it is. London house prices slump to their lowest level in 5 years. There's been a lot of talk in the press about the capital, and we all know it's a market that sits alongside the rest of the UK, almost like two markets really sit side by side. And we know that there are issues there with volume, and we know that there are issues there with prices, and we'll have a little look because that obviously affects particularly the home counties or the outer Mets as the RICS call them, but that knocks on and affects the rest of the country too. And of course, reading headlines like this, well, then that affects everybody, doesn't it, in terms of confidence? This story picking up from there, taking that one step further forward. This is a story in the FT. This was actually raised by Richard Donald, the excellent Richard Donald of Zoopla, who put this in one of his posts just a couple of days ago, actually. The gap between London house prices and other UK cities narrows. It's the narrowest it's been since 2009, as the rest of the UK market has held fairly firm and the capital has come under pressure, driven mainly by issues of affordability. And in fact, if you look at all the regional markets across the UK, and we know how much they vary one to the other, there's probably a 10% variance between the best, which currently right now, Northern Ireland aside, currently right now sits in the northwest, and the very worst, which is probably just exactly where I am standing, pretty much on the south coast, 4 or 5 miles from the south coast. But that gap has closed, and that's interesting, creates an interesting dynamic all on its own. This was a story in the Times. This was a couple of weeks ago, on May the 9th, actually. UK house prices fall for a second month. No mention there of which index they're using. This won't happen a little way off in the future because they will all be using the HDCI, won't they? It will become the UK's trusted index for prices. But as you can see there, this was taken from the Halifax. So the Halifax reported that fall at the same time as the Nationwide were reporting an increase. Go and work that one out. We'll come to that in more detail later. The Daily Mail. UK housing market sees zero growth. They were using the Land Registry Index, I think. Well, who knows? Pick any one index from half a dozen. But you can see that all of these key indices feed into the national press. That feeds into the buyer psyche, gets involved in the decision-making process, and it puts those wants-based buyers off, doesn't it? More on those later. Which has weighed in as they do. 2026 started with minor growth in house prices, but prices are now slightly falling once again. And this was the story that came out a couple of weeks ago, and yet it's referring to numbers from March because it's Land Registry numbers that they're using. But that's what's going on in the press right now. And finally, I thought this was quite an interesting one. I think this is highly relevant to our audience for today. This was a story a week or so ago in Property Industry Eye. Off-plan sales slumped to their lowest level in 12 years. Quite extraordinary, that. And actually, when you read the detail, the numbers they're talking about are actually 2025 numbers. So this is, it's a Hampton survey done with the backing of Connell's Group, obviously. And the 2025 numbers were 33% of off-plan sales of new property, of course, which fell from 36% in 2024. The high, I think, was 2016, got as high as 49%. But the thing with the level of off-plan sales, the crucial part about that is they are generally driven by the strength of the investor market. So that's something that we need to bear in mind. And when the investor market's under pressure, as we all know right now, it really is under pressure, then that percentage of off-plan sales will fall because they are the biggest buyers in that particular sector. Okay. That's what the media's had to say. And I think we can probably all agree, can't we? It's pretty bleak. And how does that affect the mood? Well, let's kick off by having a little look at how it affects consumer confidence generally. And this is a chart, excuse me, this is a chart you will have seen before. These are the consumer confidence numbers. But what I want to try and do is address these measures just one at a time because they all have an absolute relevance. They're all very important to us. This yellow line that runs right through the centre of the chart is zero. So GfK go out to 2,000 people in the UK every single month, and they've been doing that for over 50 years. Well, them and their predecessors, national opinion polls, and they asked these 2,000 people, how do you feel about this? Do you think this is going to get better or worse in the next 12 months? And if the majority say worse rather than better, you have a minus number. So you'll get a result below this zero line. The reason that zero line's not in the middle of the chart is there are very few positive readings on there. So we'd just be wasting a whole load of black space at the top of the screen. This is their overall index score, the red overall index score. And you can see, well, over here in April, it really did hit a big low, the lowest reading since that fantastic mini budget that Liz Truss and Kwasi Kwarteng dreamt up for us back in September 2022. So you can see there where we are. So it's pretty stable across the piece. I think this is very important. It's in negative. People are feeling pretty down about things generally, but it is stable. We saw a little bit of a fall off here. This started to look like a really bad trend, but it all took a bit of a kick up in May. And I know this may sound facile to say it, but actually the weather helps. Believe it or not, it's true. When the weather gets better and we come out of winter and we come into spring, that actually does help lift morale and then lift consumer confidence as a result. So that's the overall index score. But if we look at the individual measures that we measure at Henry, we measure on a monthly basis. This green line here is what's the climate for a major purchase? Is the next 12 months a good time or a bad time to make a major purchase? Whether that's a house or a car or a kitchen. And you can see that also sits deep into negative. These are among record lows, certainly of the last 25 years, or if you go back to 2008-9 before you start to see readings this low. And that again has like dipped and continued to dip and sits there just around minus 20. It's a big negative score. Doesn't stop people that need to buy buying. It just makes them think a lot harder about what they're doing and cutting their cloth accordingly. So that's a really important facet of this. If we look at this blue line that I've just introduced here, that's where we say to 2,000 consumers, is the UK economy going to do better or worse over the next 12 months? Oh my days. You know, we were doing this presentation here today. We thought we were going to have to dig a hole in the floor of our temporary studio to get that reading down there. As you can see, it actually dipped down to minus 42 points. So everyone believes that the economy is in significant difficulties. But the crucial last line on this chart is this one here, this lavender line at the top of the chart, where you say to people, OK, how do you think the economy is going to fare? And they'll go, oh, it's absolutely dreadful. And then you say, well, what about you? How do you think your own personal finances are going to go over the next 12 months? And it is extraordinary how resilient individuals are and about where they stand. And do you know, we talked about when we had all the issues, and we go back to 2022, Russia invaded Ukraine and the effect that had on oil prices, and that started to even out a little bit. Interest rates rocketed at the same time because we were just coming out of COVID, weren't we? And there was that big rush for property and buying everything, and so the interest rates went up, 16 interest rate rises in 18 months, and we know the effect that had on the market, the incredibly difficult 2023, but yet the volumes are still there. People are still buying. People still believe that they're actually going to do okay. They will battle on through and do okay. That is really important when we consider how the market's going to be through this summer and into quarter four, which obviously I'm going to touch on further towards the end of this presentation. So let's have a little look then at if we're talking about the mood, I've cut the RICS content down in here, just to one set of charts out of this deck, just very, very simply where we say, well, do the surveyors believe prices are going to go up or down over the next 3 months and 12 months? Do they think volumes are going to move up or down over the same periods? First of all, this is their headline page of their April survey. Higher mortgage rates continue to dampen buyer demand. Well, it's true. I don't think there's any doubt about that. Higher mortgage rates and, of course, consumer confidence at a very low ebb. Sales market activity indicators remain firmly in the negative. No question about that. I don't think that's telling us anything that we don't already know. But if we look at these two key charts here, first of all, in terms of volume, how many are we going to sell? Are we going to sell more? Are we going to sell fewer? Well, over the next 3 months, which is the dark blue line on this chart, you can see that a significant majority of the surveyors surveyed said we are going to sell fewer over the next 3 months. I am absolutely certain that that will be the case, regardless of what the surveyors have said. I think we have got an exceptionally difficult summer ahead of us, and we need to make some serious decisions on that basis. But if you look at their Azure blue line, this broken line here, it's about 50-50. So over the 12-month period, it's about 50-50, whether that's going to be more than the 1.2 million transactions that happened last year or fewer. I am convinced it will be more than the 1.2 million transactions, and that obviously gives you some sort of hint to the way that I'm thinking about quarter four. And what about prices? How about values? Well, have a little look over here. Again, on the short-term measure, so the dark blue unbroken line, a substantial majority of surveyors believe that prices will be lower over the next 3 months, and I am absolutely in agreement with that. I believe that that's the case. I think that through the summer, prices are going to be under extreme pressure. However, and this is really significant, it is seldom, and I've been following this index, I've been following this survey rather for a long time, it is seldom you see these lines so far apart, but the majority, albeit it's a small majority, but the majority, nevertheless, of surveyors questioned in the April survey, estate agents and surveyors in the April survey, believe that they are going to see prices higher over the 12 months as against lower over the 3 month. I think that's a really accurate reflection of where we are, quite honestly. In terms of mortgage approvals, we're starting to see that recovery in volumes, and nowhere near what I would have expected it to be. But if you think we had 63,500. March are the latest numbers I've got. The new ones are the new numbers are coming out literally about 3 or 4 days time. But the March numbers climbed back up to 63,500, which is a bit of a climb from Feb. Feb was 62,700, but crucially, the average for the previous 6 months was 63,200. So it's an increase. It's above average over the past 6 months. Those volumes have stayed there, you know. I know prices haven't moved, or they've moved backwards in the south and southeast in London, but yeah, 1 or 2 areas in the country where they've actually moved forwards. Generally, prices have been dramatically under pressure, but volumes generally have stayed there. What we've seen is more properties coming to the market, and I think that has damaged the new home share of the overall market too, which means that we get a slightly, or certainly in the new homes industry, we get a slightly different picture and a different feel of how things are. Okay, so there you go. That's the mood. That's the mood of the consumers. That is the mood of the surveyors. We've picked up what they've had to say in the media. What about the actual numbers themselves? Well, let's take a look at some of these measures that we discuss on a regular basis. And first of all, there they are, our wonderful MPC. Led by Mr. Bailey there, looking very, very serious. And they decided altogether they were going to hold interest rates exactly where they were at their last meeting. Next meeting is due on the 18th of June. OK, how about this then as a bit of a brave prediction? I think that they're going to hold interest rates at 3.75% again come June. I know that gilt yields are up. I know that there is long-term pressure on interest rates up. I know that borrowing costs for the government, given everything that's going on geopolitically as a backdrop, is putting pressure on interest rates right across the piece, and particularly in the UK. But I think, especially with the inflation numbers we've just had, come into that next, but with the inflation numbers that we've just had, I think that there will just about be enough of the doves rather than the hawks in that MPC that will see interest rates held at 3.75%. It's a great shame, isn't it? Because right at the start of the year, before we saw the Iran crisis, we thought that interest rates were going to fall quite sharply this year, and we all actually we all came into the year feeling very enthusiastic and very optimistic, and that's been given short shrift by matters that have happened that are outside our control. But next meeting, June 18. It's a really tight one. I think that they will hold interest rates where they are. Talking of inflation, well, nobody expected to see that. If you think what's going on with fuel prices and, of course, all the knock-on effects of that inflation right across the piece, everyone expected that going March into April, they were going to see another increase, going to see another climb. But actually, the CPIH, so that's the CPI, Consumer Price Index, with home owner costs included, dropped from 3.4 to 3%. Absolutely extraordinary. And even the headline numbers, the CPI itself, dropped from 3.3% to 2.8%, unpredicted right across the piece. Even the most bullish of forecasters and economists never saw that coming. To be fair, nor did I either, if I'm going to be honest. But I am absolutely delighted with those numbers. And that's another reason why I think, despite what's been said and despite the overall view, that we will see interest rates held at the next MPC meeting. A quick trot through these indices that I was mentioning earlier, I was abusing them earlier, and rightly so. So first of all, Rightmove. The Rightmove's obviously crucially important. It represents about 95% of all the properties that go onto the market in the UK. So it really does matter. We'd be foolish to ignore it. But it is the change in asking prices for new properties that come onto the market that month. So it's really important that we're aware of that. The reason it is significant, prices went up 1.2%. So from March into April, asking prices, according to Rightmove, went up 1.2%, which unbelievably is slightly higher than the 10-year average for the way that asking prices move, according to Rightmove. I'm absolutely flabbergasted, bearing in mind what I've just taken you through. And the reason that's important, now we all know very few Very few properties sell for asking prices when the market is as it is at the moment. So that actually doesn't represent the prices they're going to sell at. But the important thing that it represents is the level of confidence in people bringing their properties to the market. And maybe an element of level of desperation of agents trying to get instructions too, but that's a different thing. Sales agreed remain steady. They're just about 4% down on where they were this time last year. And well, that's only to be expected, given everything that's gone on that we've talked about. And Rightmove quote their average 2-year fixed mortgage rates at 5.18%. The institutions, the lending institutions, are working really hard actually to get those rates as low as they possibly can. And when we look at the regional picture, we look across the piece at the regional picture, you can see there that, okay, there's Scotland was actually slightly down month on month, but still 1.9% up year on year, by the way. But the whole of the rest of the UK, in terms of their asking prices, a real reflection on how confident they feel about whether they are going to get their property away, were all higher month on month from March through into April. Extraordinary but true. Here's the nationwide. House price growth remained resilient. Well, I'll tell you what, resilient? Seriously? If you want a little bit of understatement, that's your nationwide for you. From March into April, it showed an annual inflation rate that was 2.2% up to 3%. But just wait until you see the HDCI, and that will give you a little bit of a steer why we need to be really careful not to let months like this throw us off track. You know, I know for a fact there will be a bunch of people flinging their boot at the computer screen or TV screen right now thinking, you show me 3% inflation. You know, it's just not there. And of course, we all know averages, we all know how dodgy they are, and we all know that the difference in markets up to 10%. But that really, it's one of the reasons why I thought there has to be a better way than just relying on one index, because that is clearly an unreliable piece of data. Or set of data, I should say, if I'm going to be grammatically correct. Zoopla, commented earlier on about, I thought that the Zoopla index really has got better and better over the last few years as they've reworked and tweaked their algorithm. They've currently got that set at about 1.3% house price inflation. Tricky to argue with stuff like that. We'll come back to that a little in a moment. So, the market itself then, let's have a little look and see where those indices lead us, shall we? So I'm going to kick off, first of all, by spending a little bit of time introducing you to HDCI. This is the Henry Dynamic Composite Index. All right, why is it dynamic? It's because it changes, automatically changes, dynamically changes every single month, because every month when the index is recalculated, it reassesses the quality and the performance of the indices that are part of its composition, and then adjusts the weighting towards those indexes accordingly. So it dynamically keeps itself as accurate as it is humanly possible to do. So let me just show you what indices we do and what we compare. So the first one that I'll actually put on the chart here, and you'll notice that we have kicked this off. This is January 2024. This is our starting point. We know that 2023 was an incredibly difficult year, and we felt that that was the very best place to say, there we go, that's the shakeout out of the huge surge in the market in 2021, the drop off the cliff in 2022, and then the bumping along in 2023, that very, very difficult time. And we felt to kick off from 2024 would give us a really good, even start, take out some of the lumps and bumps in the market. There's nothing we can do about when the government decide they're going to change the stamp duty rules, by the way, as you can see here, because that's what happens. You'll remember when the stamp duty concession went at the end of March 2025. So that's what was going on there. So it's kicked off at 100. That is land registry. Big problem with land registry. Very, very accurate, even though they go back and adjust their numbers later on. March. It runs out in March. That's the latest numbers that you can get. Let me paint another line on there for you. This is Zoopla here. So we've also zeroed Zoopla at 100. We've given an index figure of 100 back in January 2024. And you can see how Zoopla is performing. It's why I'm a fan of the algorithm that Zoopla has. They've taken out those lumps and those bumps, and they've got that steady index. And you can see that trend-wise, it's very, very close to land registry up to the end of March. And then if we put in there the nationwide numbers, well, you can now get some idea of why I have concerns over this when you look at the way the nationwide numbers have reacted in their April numbers. This is where they are now. Look how far away that is now from the land registry numbers, which I think generally we tend to accept as gold standard. So that's as matters were at the end of March. So then, excuse me, we put in the big old daddy index, the Halifax index, and I don't mean to be, that's not me being insulting, it's just they were the first on the block, weren't they? So here's Halifax again starting at 100, and here they are sat right there where Zoopla is. Now, so take those indices, adopt land registry as gold standard, dynamically compensate and weight the other indices against their performance against land registry, and then you have the HDCI, the Henry Dynamic Composite Index. I firmly believe this will give you the most accurate removal of all those glitches and lumps and bumps, the most accurate reflection genuinely of how prices in the UK are trending. And again, I accept that this is an average, nationwide average price, and you're going to get huge regional variances. But that is your absolute best way of measuring the trend in the way that prices are moving. And it gives us a golden platform on which to forecast how prices are going to move going forward. And no one else can do it. We're the only ones that can do it. So what I've done there is I've just extended that now to May up here. And it obviously means that the land registry actually would have stopped at the end of March. But what we've done is we've applied our reverse formula using the HDCI. We've applied reverse formula to predict what those land registry numbers were going to be for both of those months. And this is where this starts to get really, really clever. So you know how modest I am. So I very modestly called it the magic. Where's my wand? Where's my wand? So here we are. Here are the numbers as we go. These are all the indices. And here's the big old HDCI sat right in the middle. Now, let us apply to those indices where consumer confidence sits. So let's just paint that line onto that chart. Here it is. This is consumer confidence. It all now starts to look like a plate full of colourful spaghetti that the kids would probably refuse to eat. So let's just try and strip that back a bit and have a little look at that. So here's HDCI working from its base of 100, measured against consumer confidence as measured by GfK since January 2024. But, and here's the key. We can all have a pretty good idea of where we are now on prices. What we really want to know is where are we going next? And the thing about consumer confidence is it obviously has to follow the sort of gestation period that any property deal has, which currently right now, 4 or 5 months. So I make my decision today and I go out and we're going to be in the market, we're going to go have a look, and it's going to be 4 or 5 months before I'm buying a property. So if we could just take that consumer confidence data and we could actually move that forward 4 months, that's then starting to give us a really accurate steer. Let me do that for you. Hold on. So these are those numbers. So here's our same HDCI as our same dynamic index, and I've now moved that consumer confidence data forward by 4 months. It's extraordinary how the movement in the index reflects consumer confidence that was as it was 4 months ago. And look what's happened here. This is where we are right now. So this is our snapshot in time of where we are now. And this is what's happened to consumer confidence. I showed you those numbers earlier. And with everything that went on, this kicked off. This big downturn kicked off as the Americans and the Israelis decided to go to war with Iran. And then the Strait of Hormuz got blocked and all of the consequent parts of that. And you can see where we've come down here over the last few months. So what effect is that going to have on the market? That's the beauty of this whole thing, because I believe that this is a base and I believe this is the start of a trend. I couldn't possibly predict whether or not there is going to be an agreement between the US and the Iranians and the Israelis in the Middle East. I mean, heavens, even Marco Rubio couldn't predict what's going on there. But for me, looking at it simply, knowing what's going on, knowing the damage that's being done to all the economies, that has to be fixed. And I cannot believe that that won't be fixed in the next couple of months. I know people have talked about it going on for forever. It won't. It will be fixed. Let's just have a little think then about how that affects our prospects before I come to that final chart. We've got a wants-based market and a needs-based market. We need to be thinking along those lines. So is our market, yeah, it would be quite nice to move because we quite like to do there or quite like to live there. Those are the people that are putting those plans on hold. Our needs-based market doesn't go anywhere. If you're buying a new property because someone in the family is having a new baby or somebody's got a new job or whatever that might be, that need is there no matter how difficult the market is. The needs-based market stays there, and it is a little bit like somebody putting their foot on a hose pipe. And as that flow slows down to a drip and a dribble, then you get a big build-up behind, don't you? And then when you take your foot off that pipeline, whoof, you get out it pours. It's what I call the foot off the pipe factor. But there's also a relief factor. There will just be, people will just make a decision based on the fact that things have been fixed and it's not going to be as bad and we're not going to have World War III. That relief factor too. So I've factored all of that into my thinking on Q4 prospects. And I might shock you when I tell you that I think Q4 is going to look like this. It's going to look like that. And I think we've got this coming up in the summer. I think that's going to be incredibly difficult. This, by the way, don't forget, is HDCI. So this is the index compared to where it was back in 2024. And it's still at plus. It's still in plus from back then. It's still in positive territory, but you can see we're going to see a move backward over the summer. And that's what I mean about difficult decisions are going to have to be made in terms of, do we maintain volume? And if we maintain volume, then prices are going to have to be aggressive and commercially minded. So to maintain volume, there will be an element of sacrifice of margin. There is no question about that. But I really think, working on what I'm looking at, the data for consumer confidence, I think if that issue is fixed in the Gulf, then the last quarter could be really big. And I think the campaign planning and the thinking about the last quarter, which should be happening now everywhere, all around the country, should be based on the opportunity the possibility of taking advantage of that opportunity. Really, really important. So, to summarise then, and I think I've run about 5 minutes over, for which I apologise. It's the first one. It's the first one of the new version. It's been very difficult trying to keep it to 30 minutes. So to briefly summarise then, will there be peace in the Gulf? Well, then nobody knows. But at some point there has to be, and I think that there is. Well, maybe it's the optimist in me, I don't know, but I believe that will be sooner rather than later. At least the extension of the ceasefire, at least things getting no worse. And that's the thing. It's people get used to that slightly higher interest rates. When the interest rates first went up, and then, oh my heaven, how's this market going to operate? Interest rates at 4% and 5%. People adjust to it, and they make their plans accordingly. I think there's every chance that we won't see an interest rate rise in June. It would be a shame if I get that call wrong, just immediately after the very first of dishing the dirt. We'll see. It's going to be an extremely difficult summer. I think that's going to be very, very tricky indeed. Some big decisions there to be made over pricing through the summer months. But everybody needs to be ready because there is the prospect for a very big quarter four. I am absolutely convinced that the chances there are very, very high. And I think that the prices will actually end up at the end of 2026. I said this last December 2025. My mind hasn't changed on this. I think that the average prices on the HDCI index, of course, are going to be pretty much exactly where they were at the start of the year. But there will be big volume opportunities. I think that we'll end the year with volumes in excess of 1.2 million. There we are. That's it. That's the first of the new dirt, dishing the dirt for you, the developer insight and residential trends. And I would like to think that's given you plenty to think about, especially as you prepare for how you're going to face up to quarter four. Okay. It's all backed by Henry. I want to say a huge thank you to all the people that have actually made today possible in the most Heath Robinson setup. If I told you that we were managing and controlling the light in the studio here by suspending an open umbrella from a piece of baling twine over the Velox window right above my head, you probably wouldn't believe me, but it's true. I'll see you perhaps in a slightly more ordered environment for Dishing the Dirt number 2. In the meantime, enjoy the heat wave. See ya. Bye.